Hello traders, in today's video I will show you how to trade divergences because they are quite good to trade, especially when you know how they form and how to trade them. Divergences are very easily combined with Fibonacci retracement because both strategies overlap quite a large number of dependencies, whether we have a strategy or not. I'm going to show you how to trade divergences. I'm going to show you their formation, when we trade them. As always, we only trade them on the trend, when to enter a trade, where to place the profit and where to place the stop. Let's see how to trade divergences. Let's start. First, of course, we will look at the file to see what divergence is, when to enter, where to place the take profits and where to place the stop. We will look at both types of divergence, for buy and for sell. I will explain all about the strategy. Let's start with the fact that divergence in translation means difference. We must have a divergence in terms of what highs the price makes and what highs the stochastic makes. This is for sales in this case. Or if we have buy, what bottoms the price makes and what bottoms the stochastic makes. Since divergence means a difference, we must look for a difference between these two tops. Now, we are going to look at both examples. And I'm going to give you a very specific examples of exactly when we have a divergence, which shows what and what is expected to happen. I repeat, divergence means a difference between the price and the oscillator. Oscillator, this is the indicator we will use, or stochastic. Its settings are 6, 4, 5. Now that we are going into trading, I will show you the settings. Divergences that are trending, they are always trending. The difference is that some are uptrending and others are downtrending. It is formed most often on 4-hour chart and on a daily chart. Most often, after the price breaks through and returns to test some strong support or resistance level. It breaks the level, comes back to test it, forms a lower high, stochastic forms a higher high. And of course, we wait for a formation of candles to enter a short position. In downtrend, the price makes a lower highs. As usual, we have an impulse wave, there is a correction, it becomes a lower high than the previous high. But note that the oscillator, in this case the stochastic, makes higher highs. It does the opposite. And what does that mean? Now stochastic makes a higher high and the price makes a lower high. The truth is that stochastic shows when the price is overbought, when it has crossed above the 80 level. Stochastic shows that the price is overbought. Buying volumes are decreasing more and more, and maybe a downward movement will follow from here. So we look for the stochastic to make a higher high, because when it makes a higher high, it tells us that the price is overbought and a fall is expected. It is when we have a lower high and a formation of candles is formed, we expect the price to fall. Of course, this strategy, divergences, goes very well with Fibonacci, because 95% of the cases in which we will use the Fibonacci, there is also divergence. And of course, this divergence happens from the sum of the Fibonacci levels. As two adjacent highs are connected, we can't connect this high and that high, and here to skip highs. Two adjacent highs are always connected. By looking with the mouse on the trading view, you look at where the stochastic bottom high is and connect the adjacent high. This is not a high, and this is not a high. Let's be clear from now on. Here in this example we have a breakout and a test of a strong level that matches with the 61.8% Fibonacci level. An engulfing candle is then formed. Once it closes the candle or a formation of candles, we already know which formation of candles to watch, the ones we have studied, a deal is entered. Profit is as on Fibonacci. As always here, absolutely always, regardless of which Fibonacci level the divergence has repelled from, level 0 is take profit 1 and 27.2 is take profit 2. Remember it. Here at the divergences, when you apply Fibonacci here, the profit is always the same. Level 0, take profit 1 and 27.2 is take profit 2. When we have a downward trend, we draw some tops. Just like we draw trend lines, we draw on tops of the stochastic. When we have an uptrend, you know we are drawing on the bottoms. We also draw on the bottoms of the stochastic. We follow the trend. In an uptrend, the price makes higher bottoms and the stochastic makes lower bottoms. We draw on the bottoms. What does this mean? Again, when the price has made an impulse wave, it returns to make a correction. Here, in this case, there is a break of previous highs. There is also a test here. Price makes a higher bottom. At the same time, stochastic, by taking the same bottom, makes a lower bottom, which means that when it is below level 20, it means that the price is oversold and buys are already expected. Therefore, you understand that when the stochastic has made a lower bottom, it has entered an oversold moment, and here the price is expected to rise sharply after that. As you can see in the example, here again we have applied Fibonacci on the beginning and end of the impulse wave. We see that there is a repulsion right from 61.8 with a pin bar and an engulfing candle. Pin bar, engulfing candle, we have a perfect entry into a geo. Of course, according to the strategy. Again, if you look closely, we have a trapezoid formed here. And this is where it gives us the opportunity to trade. It is important that there is always a divergence in these trend lines. One trend line should be up and other down. For entry, trades are entered after an engulfing candle or pin bar of the 50% or 61.8% Fibonacci level, and after the stochastic has turned strongly to the downside or upside. In this case, we have a long position. We are looking for stochastic to have turned to the upside. It will turn once the candle is formed, so don't worry. When we have sells, we look for the stochastic to have turned down. That is, if there is further upward movement here, let's not be in a hurry to enter into deals, and it should start to fall already. When it crosses the 80 level from the top to bottom, then we already know that the price will start to fall, as in this case, or if it crosses the 20 level from the bottom up, then we understand that the price will start to rise. Remember these things. Profit. We collect profit on the support or resistance levels, or Fibonacci levels, or support and resistance levels. Support and resistance levels are extremely important. Now, here we have an example. Fibonacci level 0 is the front top, but we have some daily level 1.00, that is a super round level. Don't wait the first take profit until it gets the level 0, but get it right at the level. Of course, when you collect the first take profit, you move the stop 5 pip on profit, so to protect the deal, as we already know, you pocket half of the deal and let the rest of the deal just run its course. Profit, again, or Fibonacci as take profit 1 is level 0 and take profit 2 is 27.2. Stop, placed 15 pips above the formation of candles or below 78.6 on Fibonacci. You have the option of placing a very shallow stop, not all the way to 78.6, but of course I'm not a fan of shallow stops, because many times manipulations are done, the price could go down a bit more. In fact, here it could make a better repulsion from 61.8 to turn a little more, or a small manipulation like for example with this candle could hit your stop. So I would prefer always put the stop at 78.6, with exception when you have a divergence from a trend line, because it also happens very often at the third point on the trend line that divergence also occur. Now let's see some examples on the charts. Here's a nice example because it combines many strategies, many different situations in it. So I wanted to go through it together with you step by step. So I already used the replay function, so you can see how things form candle by candle. Pay attention to everything, try to remember how in different situations how things happen. Okay, first we have a huge upward movement. The price has reached a strong level of resistance, our daily level. Then, as you can see, a trend reversing figure has been formed, a double top. We are not gonna focus on the double top, but when a trend reversing figure is formed, we are expecting a huge correction or a whole new downward movement. So in this case, as you can see here, the price tests the daily level again, then started to move down. So first thing we're gonna do is to draw our dynamic resistance zone on the tops, our trend line. Okay, you can see here if we apply Fibonacci, we have a perfect repulsion from the 61.8 level with a pin bar, so you can enter a deal by Fibonacci here. Let's continue. You can see here we have a higher high and a lower high. On the stochastic we have a higher high and a lower high. Okay, now we already draw our trend line, our dynamic resistance zone, so we are waiting to see this impulse wave and if the correction is going to comply with this trend line. The next thing we can do in this moment is to apply Fibonacci retracement here. So we can see if the price returns to this level, it will perfectly match with Fibonacci and a third point on the trend line. So we are waiting to see what will happen. Okay, let me adjust a little bit. Okay, here we have a, let me highlight it. First, second, we have a perfect third point on the trend line. We have a repulsion from the 61.8 level by Fibonacci. But before that, before we enter a deal, because we have a engulfing candle here, so this is a perfect moment for entering a short position. But again, before that, do you saw anything else? Here we have a higher high and a lower high, but on the stochastic we have a lower high and a higher high. Let me name it Divergence. This tells us that the price is overbought at this moment. And this is a third confirmation by third strategy that maybe a downward movement is coming. So we have a third point on the trend line, we have a Fibonacci retracement, a repulsion from 61.8 level, and then we have a higher high and a lower high. On the stochastic we have a lower high and a higher high. So we're not gonna enter 3 deals, we're gonna enter only 1 deal. But this is a perfect example because again we have confirmation by 3 strategies. And now we will see what happened next. But first, our stop, we're gonna comply with Fibonacci and extend our stop loss to 78.6 level. Our first take profit, we're gonna make it to the 0% level and comply with the previous bottom. And let's see. Boom, only 2 candles and our take profit is hit. Then, as we always said, we're gonna protect the deal by moving the stop on profit and extend our next take profit to the next bottom right here, maybe here, to be near the 27.2 level. Okay, and as we can see, the next candle hits our take profit too. Here is an example of divergences. We have an upward movement, a higher highs and higher lows are formed. On a first look, nothing interesting. But we take a second look and we see that here we have an impulse and a correction. We have a low and a higher low. But on the stochastic, we can see that we have a low and a lower low. Let's connect these bottoms right here. We're gonna name it Divergence. And we're gonna connect with the trend line the lows on the stochastic. We're gonna also name it Divergence. We can see that on the chart, this trend line is tilted up, but on the stochastic, it is tilted down. So that indicates us that the price is oversold right now and maybe a new upward movement is coming. So we are waiting for a formation of candles or a pin bar or engulfing candle to be our entry point. Here we have a pin bar. But before entering a deal, what else can we do? As we already said, we have an impulse and a correction. So we apply Fibonacci retracement. It is really important to know that divergences work perfectly with Fibonacci retracement. So we can see the price almost reaches the 78.6 level, but it actually didn't touch it. So we have a confirmation by Fibonacci retracement that maybe an upward movement is coming. We are not entering a deal yet, but we're gonna take another look at the chart and see what else can we do. We have an upward movement, so we're gonna draw a trend line on the bottoms. That will be our dynamic support line. Okay. Here we can see that the price doesn't comply to the trend line, but this candle right here doesn't close with a body below our trend line, only with a tail, so we can adjust it. Remember this, if it doesn't close with the whole body below the trend line, it counts like a false breakthrough. So we can adjust it, and here we have a third point on the trend line. Then the price doesn't comply to the trend line anymore, so we're gonna erase it. Then we're gonna draw on the next bottoms. The price doesn't comply to it neither. So what else can we do? We're gonna draw it on the next bottoms. And here you can see the price perfectly matches the trend line, and here we have a third point on the trend line. So first we have divergency, we have a low, a higher low. On the stochastic, here we have a low, a lower low. Then we apply Fibonacci retracement because we have an impulse and a correction. And we can see that here the price almost reaches the 78.6, but it actually didn't, as we already said. So we have a pushback from the 61.8 level by Fibonacci retracement. And then we have a third point on the trend line. Those are three strategies that indicates us that the price will go up. As we already said in the previous videos, when we have a confirmation by two or three strategies that the price will go in some direction, there is a great chance of successful deal. So this is a perfect example. Here we have a pin bar. This is our entry in a long position. Stop. We will comply with Fibonacci, but even if we make our stop by divergency, it would be 20 pips under the last candle. In this case, 120 pips. You can see it matches with Fibonacci perfectly. This is not coincidence, of course. Our take profit on the last previous stop. Again, it matches the Fibonacci perfectly. Not coincidence again. And you can see here our take profit is hit. Then, after our first take profit is hit, we're gonna protect the deal by moving the stop on profit. Then we're gonna extend our take profit on the next daily level. Here we have a strong daily level, so we're gonna adjust our take profit again, maybe 5 pips under it, just in case. Again, let's repeat everything. We have an upward movement, then we have a low and a higher low. On the stochastic, we have a low and a lower low. We wait for a formation of candles or pin bar or engulfing candle to be our signal for entering a long position. Then we apply Fibonacci to see if there is a confirmation by Fibonacci retracement. We look if there is a third point on the trend line, and that will make us more confident of our deal. So we are entering a long position, and as you can see, the price continues its upward movement and our second take profit is hit. Let's look at this example of divergence. First, we have an upward movement, then something like a range, and we have an impulse wave and a correction. So we don't have anything like trend reversing figures or something like that. It is not necessary to have it all the time. Remember. So we are analyzing the chart, we are looking, and here we have an impulse and a correction. First thing we have to do is to apply Fibonacci. We apply Fibonacci and we can see that the price didn't touch the 50% level. So we don't have Fibonacci here. So we continue to observe and we can see that here we have a higher high as a beginning of the impulse wave and a lower high as the end of the correction. But on the stochastic, we have a lower high and a higher high. Let me name it so you can see them perfectly. Here we have a higher high. Then we have a lower high. But on the stochastic, we have a lower high and a higher high. This tells us that the price is overbought at the moment and maybe a fall is coming, a fall of the price. So we are preparing and we are waiting for a formation of candles or engulfing candle or pin bar to tell us where exactly our entry point in short position is. So here we have a perfect formation of an evening star. So we are entering a short position. Our stop loss, 20 pips above the second high of the last high. Let's make it 63. Our take profit gonna be on the last bottom here. We may adjust it to the daily level, as we already said many times. And when the price hit our first take profit, we're gonna protect the deal by moving the stop on profit and extend our next take profit. You can see here we have a repulsion here, so we're gonna make it to this bottom right here. This is going to be our second take profit. And our second take profit is hit. So again, we have an impulse wave and a correction. So we are applying Fibonacci. We see where the correction ends. In this case, we don't comply with Fibonacci. So we're looking that we have a higher high. Let me connect them. And a lower high. We're gonna name it Divergence. But on the stochastic, we have a lower high and a higher high. That tells us that this correction right here, in this moment, the price is overbought. And maybe a new impulse wave is coming. So as we already said, I'm just repeating this. You are waiting for a formation of candles or engulfing candle or pin bar to tell you where your exact entry in a short position is. And as you can see, our take profit is hit. Okay, traders, now you learn how to trade divergences, how to combine it with other strategies. So practice and see you in the next lesson.